Good morning, students. Welcome back. So today we are going to start with this another chapter, which is chapter 6. And in respect of the topic, it's about the completion and review. So we have been discussing about the audit strategy in terms of audit planning, what all things are required to be considered. Then we also talked about the execution part, okay, which in fact was the focus area in the previous session. So today we can say that again it's a continuation of that, yeah, because you can say that it's a process around the audit which is now going on. That is what we are discussing. And during this process, some of the additional considerations that the auditor is going to have. So that's one area we'll look at. Plus, there are some more areas which are particularly focused towards the closure of the audit. Means when you will come towards the end, that is when you will pick up these areas generally. It's not that you will not do that earlier. Briefly, you can start on that, but dominantly, it's the one which is which becomes relevant towards the end. So that's where you keep coming to some of these aspects. Okay. So now we'll be talking about that. So one is this subsequent event that we are going to discuss. Then we have this going concern issue. And then, of course, we have this another requirement in the form of representation letter to be obtained from the management. So we'll talk about all of these one by one, right? So let's begin our discussion with the subsequent events. SA 560. Okay. Now, let's try to understand what a subsequent event is. Okay. And once we have that clarity as around the subsequent event, that is when we'll get on to the discussions related to subsequent event as far as the audit implications are concerned. All right. So that's we'll plan to do. Okay. So now let me just open one working file and therein we'll discuss. Just give me a minute. Right. So here we go. So there is a accounting standard. Okay. Now this accounting standard talks about events occurring after the balance sheet date, right? Now, what does that accounting standard requires? Now, you may be thinking that why we are talking about accounting standard, because those are the implications, or you can say implications of the events which are going to be there after the balance sheet date. That's required to be considered by the auditor as well. Okay. So let's suppose we are looking at a period, say from 1st of April 2024 to 31st March 2025. Yeah. So say this is the period we are looking at. Okay. So this is the financial year, right? Now, in respect of this period, the balance sheet date happens to be 31st March. Now, first of all, in a very simple manner, if we have to talk about subsequent event, what do you mean by subsequent event? Subsequent event means any event which takes place after the balance sheet date. Okay. Why? Because if there is an event which is taking place up to the balance sheet date, up to 31st March, so its recognition in the financial statements will take place in which financial year? 24-25. Correct. So that's the understanding. However, if you look at the things practically, okay, to say that financial statements of 31st March are prepared, they are closed. So it will not happen that the financial statements will be prepared and closed and finalized as well as audited by 31st March only. Practically, that is not possible. So what will happen? There is a time period, right? From 31st March, you'll have to look at a time period, say maybe a month or 2 months, within which financial statements will be prepared. In fact, the books of accounts will be closed. Okay. And once the financial statements are prepared, closed, so what will happen? We will have this requirement related to audit, right? So let's suppose company has decided to keep the board meeting. Say the board meeting will take place on 31st May 2025. Now, 31st May 2025 is the date when the financial statements will be signed off by the board of directors. Okay, so they will be authorized. Okay. Now, in this case, if you look at the accounting standard, Ind AS 10, I believe, any event which takes place during this period. Now, this is important. Which takes place during this period means after 31st March up to 31st May. So what do you do about this? You will check whether these events are adjusting events or non-adjusting events. Okay, so that's the thing you will check. Now, what are adjusting events, non-adjusting? I understand you have a clarity on that. Okay. Anyways, we are not getting into the details of the accounting standards. In case those are adjusting events, then the management is required to recognize them. Now, important part is recognize them during the reporting year itself. So what is the reporting year? This is the reporting year. Okay, so this is when the management is required to record them, recognize them. In case the events are non-adjusting events, then when do you record? If you look at it from the management's perspective, the day when the event has taken place. Means, do you go back to the reporting year in such a case? No. No. In case of non-adjusting events, you will not do that. But considering the importance of the matter, means considering the materiality, I should say, you will assess as to how important it is for the understanding of the users of the financial statements, and therefore, depending on the materiality, you will disclose that as well. Okay, so that again will be disclosed in the financial statements of the reporting year itself. It will not be recognized, so it will be recognized here, but disclosed here. Okay, yeah. So this is what the Ind AS requires. This is what the accounting is required to be done. Now, let's talk about the audit. As an auditor, you need to ensure application of this particular Ind AS. Now, management has done this exercise. Let's suppose during the year, in fact, during this period, I should not really call it as an year. Let's suppose during this period, there are various events. Obviously, there are a lot of events which will take place. So management has considered all, analyzed all, and whatever was required to be recorded, they have done this. As an auditor, how will you check? How will you get to know whether the events were adjusting or non-adjusting? How will you assess whether those have been appropriately captured by the management? Yes or no? Yeah. So Saminathan, any thoughts as you are around? What do you think should be the audit procedure in this case? Yes, please go ahead.
Hello, good morning, sir.
Good morning. Good morning. Yes, please go ahead.
Okay, sir. First, we will inquire to the management, sir.
Okay.
First, is there any subsequent event happened during the period?
Okay.
And also, as part of the audit, during the audit, they implement the audit procedure, and the auditor himself came to know that there is a subsequent audit event, and he will
Okay.
also check and discuss with the management to understand that significant event, and auditor will ask them to incorporate in that financial statement.
Right.
If they incorporated and disclosed us appropriately, then there is no need to issue the qualified report.
Okay.
And see, if the auditor is came to know that after issue the audit report,
Correct.
then that situation also that material effect known to him. But in that case also he will discuss with the management and
Right.
ask them to know what is the idea behind how to go about it, the matter,
Right.
and accordingly, if they are ready to adjust and incorporate in and disclosure, then okay.
Yes.
Otherwise,
Right.
that auditor will do that qualification as well.
Okay.
And if that auditor report is issued
Yes.
and published, that also that auditor has to be taken the precaution to not to circulate if not circulation done.
Okay.
and the significant matter is there, then accordingly we have to decide. So,
Right. All right. So good for sharing your thoughts on this. Now, let's continue our discussion and something to add to what Saminathan just mentioned. See, first of all, auditor will also be required to look into these events. Yes or no? So he needs to find out these events first of all. So one is, if the events are there, what is it he'll do? So that of course we need to know. But before that, we also need to know what are the events, or there are events or not. Because as an auditor, you just can't simply rely on what the management is doing. Okay. So therein, as an auditor, what do? You will perform inquiries. Yes or no? Yeah. So that's one, right? There is another important procedure, number two, that is about testing of these subsequent periods. So he pull out the financial information for this period from 1st April to 31st May 2025. Now, because 31st May is the date when the financial statements will be signed off, so that's why he can't reach this date exactly. Okay, he'll take a cutoff. Let's suppose he has taken a cutoff of 25th of May. So up to that date, he will do a testing. He will do a scrutiny of the ledgers, of various information. He'll draw the analysis. He'll go through the minutes of the board meetings, if there are any during this period. Okay. Now, some of these things will provide him the information about any of the developments, about any of these events which would have taken place. Okay. Now, generally, there is a thought that our reporting year is what? Our reporting year is this. Okay. So, should we be auditing only this period? And why are we moving on to the next year? Yes or no? Yeah. So, generally, there's a thought that why are we moving on to the next year? Why are we performing procedures on that? Why are we testing that information? Yeah. So, hope you have now understood that without you do that, so of course, this important aspect will get missed out. And to say that the auditor will only perform the inquiries and not do anything beyond that will not give him the complete information. And he can't just simply rely on inquiries. He needs to do something beyond that as well. Right? So that is again important for the auditor to consider. Okay. Now the next question arises that what if he has done what was required to be done in respect of subsequent events as well? Hope you have clarity as to what a subsequent event is. Let's suppose he has done what was required to be done. Okay. And there are some events which have come to his knowledge. So what do you do about it? So let's break it into few parts. Okay. Now, first of all, let's talk about the events which occur between the financial statements and the auditor's report date. Okay. Now, in this case, one should understand that auditor's report is not yet issued. So if there is something around this period which has come to the knowledge of the auditor, which is significant and which requires adjustment in the financial statements. So the audit actually is going on. Yes or no? Yeah. So you can say that during the audit process, auditor will have to take the auditor will have to bring all of these matters into consideration. Auditor will now be required to make this a part of his audit process. Its implications in the financial statements, and if at all this has not been incorporated in the financial statements, implications on the auditor's report. If there are any changes required to the audit plan, audit strategy, materiality considerations. So some of these things which the auditor will do during the course of his audit, you can say it's something which will be incorporated in his work, okay, in his process. So that's how we are required to look at it. If this is significant, management doesn't record it, then the auditor will have reporting implications. Correct. So we can say something around the facts which are there, or the information which is there up to the date the auditor's report is not signed off. That entire part remains open. Okay, so that's not going to be a challenge for him. Right? Now, let's talk about the facts which become known to the auditor after the date of the auditor's report, but before the date the financial statements are issued. Now here comes the practical aspect as well. So let's suppose financial statements are issued, say on 7th of June. Okay. Say audit report is issued on, say for example, say 1st of June, or maybe say 31st of May. See, generally there will not be a significant time period in between this. But if at all there is a time gap, as we discussed, generally the time gap will not be there, but if at all there's a time gap, and during this period there is something which has happened and which has come to the notice of the auditor as well. Now what will happen? Now the audit report is already signed off. Okay, so you can say an audit report has already been issued in a way. Now this will require discussion with the management and TCWG, because we are talking about only the critical matters. Okay, so on a routine basis, you can say a lot of things will keep coming. So we are not talking about that, right? We are talking about something that is critical, something that is important for the auditor to consider. Now, in this case, management must be considering, and the auditor will also be considering, whether the financial statements need amendment due to this. And if yes, whether the management is doing that or not. See, if the management amends the financial statements, then of course, auditor will have to, you can say, now extend his audit process. Okay, so on that additional part, which will now move into the financial statements, auditor will have to top up that part with his or audit procedures. Yes or no? And of course, auditor may either require to amend the audit report, or maybe provide a new report, which is going to be an amended report, okay, wherein EOM or the other matters paragraph will have to be included as around this matter only, right? However, if the management doesn't intend to amend the financial statements, but the auditor is of the view that the financial statements need adjustment due to this matter, then what will happen? Then the auditor doesn't have a choice but to modify the opinion. Yeah, because the matter is critical, so auditor will have to consider the reporting implications. And in those implications, modification would also be required. If the audit report has already been provided to the management, notify TCWG not to issue it to third parties. Now, this is important. If still issued, then take appropriate action to prevent reliance on the auditor's report. Okay. Now, moving on to one more situation. See, situation number one is very practical. Situation number two, as we discussed, is going to be the one where in practicality you'll find gaps, but those gaps are not going to be much and always. Third, facts that become known to the auditor after the financial statements have been issued. Okay. Now comes another problem. See, it's like financial statements have gone out. And now comes a matter related to the reporting year itself. See, there are a lot of matters as we discussed. They will keep coming up and all of them will be critical. But over here, the consideration is what? That such matters which require adjustment in the financial statements of reporting year itself have come up. Okay. Yeah. So that's the challenge. And that's why we are having this consideration. Now, in this case, what is it that the auditor will consider? Here again, first of all, he'll have to have a discussion with the management and TCWG. Yes or no? Here again, it will have to be evaluated whether financial statements need any sort of amendment or not. Inquire from the management as to how do they want to address this, and review if the management has taken steps to inform about the situation to everyone who is in receipt of the financial statements which have already been issued. If the steps have been taken by the management, issue new report with the EOM or other matter paragraph. If not, if let's suppose management is not doing anything about it, then the auditor will have to take the steps. Okay. So that the stakeholders, the users, they are not placing reliance on the audit report, because the financial statements are not the one which have been made with such adjustment. Okay. So that's why audit report which has gone out is again inappropriate. Yeah. So that's something which the auditor now needs to make the other parties aware of. Clear on this? Yeah. Now this is something which is important consideration, not only from the management's perspective, but also from the auditor's perspective. Okay. Now let's move on to the next area. Again, a very important area, going concern. Now, going concern SA 570. Let's again understand as to what this going concern talks about as far as the financial statements are concerned. Means what is it that the management is required to do? Let's talk about that first, and then we'll discuss as to what the auditor is required to do. Okay. So now, talking about going concern. So let's suppose once again we have this reporting year. Say 24-25, right? This is the reporting year. This ends on 31st March 2025. Okay. Now, as regards this reporting year, when the financial statements are prepared, so we can say there is a presumed understanding about the future period. Okay. Now, what is that? That the entity will continue or will be able to continue its business. Yeah, it will be able to operate its business for a foreseeable future. Means in the future, entity will continue to run. That's the assumption. Okay. Financial statements are prepared based on this assumption only. And this is also called as fundamental accounting assumption. Now, in this case, there is a bare minimum expectation of the accounting standard. What is that? That at least up to 31st May 2026, sorry, 31st March 2026. Okay, at least for the next 12 months. If you look at the period from the balance sheet date, okay, at least for the next 12 months, company should be able to continue its business, at least for the next 12 months. This is the bare minimum expectation. And that is the assumption which is taken. So it's assumed that the company will be able to do this. And based on this assumption, what do they do? Company will say that yes, my going concern assumption is appropriate, and they will prepare their financial statements. Now, what do you mean by going concern assumption is appropriate or not appropriate? Let's try to understand that. Let's suppose if we say that this going concern assumption is not appropriate. Okay. In that case, in a way, what are we thinking? That the company will not be able to continue its business. Okay, it's about the ability. It's not that the company wants or not. Okay, so please understand that it's not about intent. It's about the ability. So if the company, let's suppose we are saying, may not be able to continue even for the next 12 months. So what will happen? So in a way, company will be shut down, right? So company will be liquidated somewhere during this period. If that is the case, okay, what should the company do? Then the standard says company should incorporate this assumption, or should say that should change this assumption of going concern as appropriate to not appropriate, and thereby incorporate this new assumption, or you can say a completely different assumption, and thereby record the balance sheet items, all of its assets, liabilities at NRV. Why? Because the company is going to get liquidated. So why to keep the items in the balance sheet at historical cost or fair value? No, they should be moved at NRV. Means the values the company is going to get if the company gets liquidated today. So that's how the financial statement should be prepared. Okay. When do you do this? If the going concern assumption is not appropriate. Otherwise, you don't do that. Otherwise, what you do, you'll keep the items at historical cost. Means you don't bring them to their NRV. And we are talking about all the items in the balance sheet. So we are not talking about inventory. So you may be thinking, but sir, this term is used in the context of inventory. So we are not talking about inventory right now. And there again, you do a comparison of what is lower. Over here, we are not making a comparison. Over here, we are saying that if let's suppose this assumption is not appropriate, then you have to bring them to NRV. Okay, whether lower or higher doesn't matter. You bring them to NRV. Okay, so such is the implication. Now, because this is fundamental to the entity and it's a fundamental accounting assumption. So that's why every time the financials are prepared, you don't talk about it. Means you don't disclose whether the going concern assumption is appropriate or not. Because it's assumed it's there. Yes or no? So every time it will be assumed that it's already there. Right? So that's why you don't get into this. Clear? Yeah, because it doesn't make sense when you're assuming that to be there. So why will you get into that? Correct? Now, in this case, what is it that the auditor is required to do now? And what is it that the auditing standard requires now? So this is something which we discuss from the management's perspective, means from the company's perspective. So from the company's point of view, you will think about it. And this is how you'll do the accounting. This is how you'll present the financial statements. Correct? So we have looked at the financial reporting requirements. Now, what is the role of the auditor? To ensure what is required to be done has been done or not. As simple as that. Yes? So in this case, to check what is required to be done has been done or not, auditor will have to perform some procedures. Yes or no? Yeah. So in this case, one very important consideration on the part of the auditor is to analyze, to look at the events, to look at the circumstances which may result in going concern assumption becoming inappropriate. See, every time the auditor is there, so he'll not say that the going concern assumption is not appropriate. No, that's not how you will go about it. There has to be something which will trigger this. Now, what could that be? Okay, there could be some indications which are important. Let's try to understand. If let's suppose company has been incurring losses year on year. Okay. Now, company's net worth is getting eroded. And as regards the future period, there is again no clarity, okay, as to how the situations will improve. Okay. Means company is going to face such type of financial difficulties in the foreseeable future as well. For a company, it is very, very important for it to run. It needs to have cash flows. Okay, profitability is important, no doubt, but cash flows are all the more important. If you talk about the current liabilities of the company, so why do we call them as current? Because they need to be settled within 12 months from the balance sheet date. For that, company should have current assets. What if the current assets are not adequate to pay off the current liabilities? What if the company doesn't have the cash flows for the next 12 months? So, how do they survive? If they don't have that, what are the plans of arranging these cash flows? So, something must be there on the part of the company. These days, you get to hear about the companies that they have defaulted on the loan payments, they are getting into this restructuring. Okay, a lot of companies are moving into this insolvency. Okay, which is again a process in itself, wherein you get into this evaluation as to whether the company will be uh, able to pay off those liabilities or not, right? So these are some of the triggers, you can say, basis which this assessment around the going concern becomes all the more critical. Yes or no? Yeah. So that's something which the entity is required to consider, right? So this becomes important, right? Now, as regards this going concern, some of the things which the auditor will pick up, some of the things which the auditor will discuss are important. What if some of these things have been picked up, but the auditor still has a problem? And what is it that the auditor will want to obtain as information from the management? So let's try to get into those aspects as well. Okay, because the auditor will also need some information to work on, pick up some of those aspects. So now comes the point that what is it that he will want to look at? See, over here, the most important information for the auditor will be cash flow projections. Yes or no? So we can say for the auditor, these cash flow projections for the next years, for the next 5 years, 3 years, or at least the next 12 months is very important. And now we are not talking about the actual number only. See, the actual information, by actual, I mean to say the information for the reporting year. That would have, of course, been audited. Over and above that, auditor now needs to know, auditor needs to have a clarity as around the future period as well. Okay, so that is where this cash flow projection becomes critical. And the basis for this, because when the auditor will get on to these projections, this will be a data. All of these are numbers. So practically, if you look at the cash flow projection, so basically it's about an Excel file. Okay, so we are not talking about the Excel file here. Yeah, because on an Excel, any number can be put up. There has to be some basis for doing that. The management must be making some assumptions as to how do they achieve profitability, how do they achieve cash flows also. So auditor needs to get into those assumptions. He'll have to challenge those assumptions. Not because he has sort of negative mindset, but to ensure that anything which is there is in line with the actual numbers also. Okay, so that should be reasonable, that should be logical. Just for the sake of putting the numbers, it shouldn't be put there, right? It has to make some sense. Now that's something which is important, right? Now, talking about this further, many a times what may happen, let's suppose financial position, financial performance, cash flows of the entity, all of these things are not giving the comfort to the auditor. Okay. So auditor is not very comfortable with them, but somehow the management is able to convince through the information, through the details which the auditor require, or you can say with the relevant evidence. Now in that case, auditor and the management may be of the view that as far as the going concern assumption is concerned, okay, so we are talking about going concern assumption. So yes, going concern assumption is appropriate. Okay, so what was the question? Whether the going concern assumption is appropriate or not while preparing the financial statements for the reporting year 24-25. So let's suppose going concern assumption is appropriate, but there's a material uncertainty as around the going concern. Okay, why? Because if the company is facing financial difficulties and which are going to continue, over which some uncertainty is attached, okay, so what do you do in that case? Yeah, so that's something which becomes important. In such a case, what will happen? In such a case, it will be important for the auditor to look at that material uncertainty. Why? Because all of these things will have some reporting implications. Okay, now let's try to understand. See, now in a way we are saying that the going concern assumption is appropriate, but material uncertainty exists. So what will the auditor do? So there are some reporting implications around it. Okay, so now let's talk about all of these reporting implications now. Okay, so let's get on to that aspect. Let me just open a document. Right. All right. So, okay, so let's quickly look at some of the points as around the discussions that we have had. See, first of all, it's the management who has done the assessment, right? They have looked at it, because for the purposes of preparing the financial statements, it's important. Otherwise, the way the financial statements are prepared, some of those things may change, and the way they are prepared may also be changing. Okay, a lot of factors may have an impact on that. Now, when it comes to the auditor's assessment, what is it that he'll do? Auditor will assess what the management has done. Auditor will look at the assumptions of the management, which are very important. Huh? Because these have to be logical, these have to be reasonable. Okay, otherwise it's a problem. And these assumptions have to be for 12 months at least, because that's the bare minimum requirement. Yes or no? It has to be for at least 12 months. That's the bare minimum requirement. Okay. Now, if we talk about some examples of events or conditions that may cast significant doubt on entity's ability to continue as a going concern. So we discussed that some of the factors the entity will have to consider, but there are a lot of factors. Okay, so the auditing standard lays down some of those factors, and you should not be thinking that it's an exhaustive checklist. No, these are only the indicators. These are only the factors. Now, what could those factors be? So let's understand what could those factors be. You can have some of the financial factors. In which case, what will you have? Current liability exceeds the current assets. Net worth is significantly eroded or is negative. Short-term borrowings are used to finance long-term assets. There is an indication of withdrawal of financial support by the creditors. There's a default or delay in repayment of loans. Okay, something that you get to see. Operating cash flows are negative. Now, see, for a company, when you look at the cash flows, so what do you have? Three types. From operating activities, from investing activities, and from financing activities. Correct? Now it's extremely important that these operating activities are positive. Yeah, because it's all about the operations of the entity. It's all about the core business of the entity. Yeah. So this has to be positive. And you can say that's a reflection of the business of the entity. So the entity may have the net cash flows as a negative, which can still be understood. Okay, because of the challenges related to finance, for the challenges related to the expansion. Okay. But as far as the operations are concerned, it is always expected that the cash flows should be positive. So what if those are negative? Means somewhere in the operations, entity is not able to generate cash flows. If you look at the key financial ratios of the entity, they are adverse or they are becoming adverse day by day. Company has substantial operating losses. Now, please remember, profitability is one part, cash flow is another part. So at one place, what did we discuss? cash flows are negative. Operational cash flows are negative. Now we are saying operating losses are there. Means from the operations, company is incurring losses. Inability to pay creditors on due dates, inability to obtain the new financing. Now, this is also a challenge. Okay. So if the company will continue to obtain finance, means the loans, one may say that yes, company has got the loan, so the company will have the cash flows to run the business. What if the company will not be able to get that? So how do they survive? Because cash is required for sure. Okay. Right. So this can also be a big problem. Okay. Similar to the factors that we discussed, there could be some operating factors. So the management intends to liquidate the entity or to cease operations. Let's suppose KMPs who are critical to the business, or one of the KMPs has left and there's no replacement. You can see there is a loss of major market, key customer, franchisee, license, principal supplier. Company is facing labor difficulties, which are significant. Important supplies, which are there for the company's survival. Okay, so what do you see? There's a shortage of that. Okay, these are all what? Operational challenges, but these are all critical one for the company's survival. These are considered to be critical. Okay, or maybe the company has started facing some competition now, okay, which can again put a question mark on its survival, right? Now, in relation to the audit procedures, what is it that the auditor is required to do? See, very simply, you can say that some of these factors we have discussed, auditor needs to be aware of that. So so the first point is auditor needs to know about the factors. Means it's not about the knowledge; it's about whether those factors are seen in the in relation to that entity or not. Because he can do anything only when he'll get to know about it in relation to that company. So which means auditor will have to find out. Auditor will have to identify. So how will the auditor do that? Very important point. Analyzing the cash flows. So the cash flow projections. A very important, very critical procedure. As well as the information which the management will have to provide. Okay. Reading the terms of the loan agreements, any type, determining whether there is any breach and what are the implications due to that. Okay. Reading the minutes, see minutes of the board meetings, audit committee meetings, wherever that applicable. Again, will give very important and relevant information, particularly around such type of matters. So that's why it's considered to be an important area anyways, and it's considered to be an important information anyways for the auditor to look at, right? Inquiry of the entity's local council. Now they will also have insights around it because they must be involved in some of these matters in terms of supporting the company. Evaluating the entity's plan to deal with unfilled customer orders. So when the financial difficulty is there, entity may not be able to maybe meet some of these requirements. Okay, and at times reviewing, obtaining the reports of regulatory actions if there are any. That can again have a significant implications as far as the company is concerned. Okay, yeah. Now, in this case, once the auditor has done this, he has looked at all of these aspects. He has got the information. So there are few situations which are possible. Depending on the type of situation the auditor face, reporting implications will also change. Okay, so let's try to understand that. I would say when it comes to this auditing standard, this part that we are going to discuss now is the most important part. Okay, yeah. So this part, in fact, this flow chart which you can look at will really help you. Why? Because it summarizes the entire reporting implications in relation to the entity. And when it comes to the audit areas, okay, so this going concern assessment, I would say in any case, is a very important assessment in relation to any type of company, particularly the ones wherein you see such type of financial difficulties which the company is facing. Okay, now let's talk about all of those situations one by one, right? Now, what is the first situation? Say the going concern assumption is inappropriate. If the going concern assumption is inappropriate, what should the management do? Prepare the financial statements wherein the balance sheet will be recognized, will be remeasured at liquidated values. Simple as that. So that should be done if the going concern assumption is considered to be inappropriate. And because the going concern assumption is inappropriate, so that's why a disclosure in that respect will also be required in the financial statements. Yeah, which is a very basic requirement. What if the management doesn't do this? Okay, so they don't bring their assets liabilities to the liquidated values. Yeah, so what if the management doesn't do that? Then we are looking at a situation wherein the financial statements are misstated. Okay, and of course this impact is quite significant. So we are not only talking about it from the materiality perspective, there's also a concept of pervasive, okay, which anyways you are going to cover later on. So as of now, we can just simply touch upon that. So you can say it's quite severe, right? In layman terms, we can say it's quite severe. Its reporting implications, therefore, are going to be quite significant. And what is that? Adverse opinion. Okay, so this will lead to adverse opinion. Right? Next situation. So this was situation number 1. Next situation is, so the going concern assumption is appropriate. Okay, so auditor has done the exercise, management has also done the exercise. So going concern assumption is appropriate. That's what the management has assessed. Auditor is also fine with that. Right. So auditor is saying, yes, fine. The going concern assumption you have taken is appropriate. So I'm okay with that. So auditor is convinced as far as the going concern assumption, right? But material uncertainty exists. Okay, material uncertainty exists. Now, does it require the balance sheet to be reported at those liquidated values the way we discussed in situation one? No, no, that's not the case. So let me just call it as situation two. That is not required to be done. But in respect of such material uncertainty, because it's a very critical information, it's very important that management discloses that in the financial statements. So there should be an appropriate disclosure. A disclosure should be given and appropriate disclosure should be given. Why? Because it is critical for the users of the financial statements. It's a very important information for them. Yeah. So that disclosure is required and that disclosure has to be appropriate. Now, in the given situation, going concern assumption is appropriate. Material uncertainty exists, but in respect of that material uncertainty, management is not ready to give appropriate disclosure. Okay, so this is 2A, this is 2B. Now here again, if the management is not ready, so what will happen? You can say there is a disclosure deficiency. Now, depending on again the criticality of the matter, it's no doubt material, right? So even if there is a material disclosure which has got missed out, that's quite severe. Okay. Over here, the auditor will have to analyze whether to go for qualification or adverse opinion. Okay, so here again, modification will be required because disclosure is inappropriate, or maybe the disclosure is not given at all. That again is inappropriate. But in this case, what will happen? Auditor will have to analyze whether to go with qualified or adverse opinion. It could be either of these depending on the assessment. Okay. Now there could also be another situation, third situation. Now in this case, what has happened? Going concern assumption is appropriate. Material uncertainty exists, okay, for which management has given an appropriate disclosure in the financial statements. Now, should this be a problem? Answer is no, because something that is required to be done has been done by the management. Okay. So should this result in a reporting implication, means resulting in modification? No, that will be wrong. Okay. So that's why what should happen? Unmodified opinion should be given. Right? But in this case, even though the opinion is clean, okay, so it's a clean opinion. Unmodified means it's a clean opinion. You can say there is a requirement of the auditing standard that this material uncertainty which the management has disclosed, auditor also needs to highlight that. Okay. So it's about emphasizing on that disclosure in the audit report. Something that you do through emphasis of matter, for which there is a provision in the audit report to include a para called as material uncertainty related to going concern. Okay. So now this para will have to be included, right? So this para will have to be included in the auditor's report. Okay. So this is what the management will be doing, and this is what the auditor will also be required to do. Okay. So in this case, management has given the disclosures and road auditor is not bringing in any modification. It's just that somewhere in his report, he's highlighting that. When you go look at that disclosure, just make sure you read that. Okay, which is very commonly called as MUGC para. So this para will be included in the auditor's report. Now, can we say that this para is a kind of modification? No. Okay, so generally there is a thought process that if you include anything in the audit report, yeah, any of these things is generally considered to be a modification, but that is not the case. Okay, it's not a modification. Clear? So I'm just hoping that this summary helps you in terms of analyzing the impacts and in terms of assessing the reporting implications. Yeah. Any questions so far? Yeah, all good so far. All right. Great. Saminathan is clear. I'm hoping everyone is clear. So going concern assumption is to be made at standalone level or group level. Yeah, so that's the question. So it has to be made at the standalone level because we are looking at it from entity's perspective. Yes or no? Right? Now, let's look at one question. And in respect of this, we'll try to discuss some of the matters related to going concern. Okay. ABC Limited is a manufacturing company. So we have in place a manufacturing company. Okay, so it's continuously making good amount of profits. It has high dividend payout ratio, right? So good profits, dividend ratio is also, so means it talks about the financial situation of the company. Seems that's quite strong, right? In June 23, subsequent to the year end. So we are talking about, let's suppose, reporting year 22-23. Okay, so we are talking about that reporting year 22-23. So that's the year we are talking about. Okay. In June 23, subsequent to the year end, High Court has imposed significant amount of penalty on the company due to non-compliance of some environmental norms. Now the penalty is so significant that it will erode the entire net worth of the company. Okay, means it's a financial penalty, but the amount is quite significant. Management has filed an appeal with the Supreme Court. So management is contesting that its survival becomes a question mark. Yeah, because if the impact is so severe and the management is confident of a favorable order, so they've also got a legal opinion, right? So management is quite confident about it. Okay. Now, in this case, some of the questions that we can consider. while auditing the financial statements for this reporting year 22-23. As an auditor, should we take into consideration events which happened after the balance sheet date? So please remember, we are not talking about subsequent event. So the question is in context of going concern assessment. So for this going concern assessment, should the auditor look into the events subsequent to the balance sheet date? So that's the question. Okay. So it's quite focused towards going concern assessment. So for doing that, will you be getting into the subsequent event uh, or subsequent period information, details, etc.? What do you think? Saminathan says yes. Yes, of course. So we will be needing that. And why is that so? Because as we discussed, when you look at the cash flow projections, how does it help? It helps the assessment of what? Of the liquidity. Because when it comes to the going concern assessment, we are not looking at the past period. We are looking at the future period. So if you have to get the comfort over the future period, you will get the information. So sorry, you will need the information for the future period, because without that, you will not be able to do that. Yes or no? Yeah. So that's why, of course, this will be required. Now, what would your conclusion be in the given situation and why? Okay, so if you look at this situation, in this situation, looking at the situations that we discussed, so what would your conclusion be? Means, are we on 1 or 2A or 2B? What do you think? Tell me. Use of going concern assumption is appropriate, is inappropriate, is appropriate, but material uncertainty exists. Saminathan says it's C. Means it's appropriate. Yes, of course. Why? Because there is no doubt a penalty has been imposed, but there is uncertainty as to whether this amount is payable or not. That's why the company has got filed an appeal. Okay, and it's also given that the company is confident of favorable order. Now you may be thinking that if the company is confident, then why are we saying there's a material uncertainty? Because it's a matter related to litigation. Amount involved is quite significant. So that's why we should consider this material uncertainty, right? What would be the reporting implication? Now, what would be the reporting implication? If the management has adequately disclosed the matter in the financial statements. I think quite simple for you to answer. In this case, what do you think will be the reporting implications? Okay, great. So Saminathan says C. So let's read all the options. Adverse opinion. See, when do you give the adverse opinion? When the going concern assumption is inappropriate. So in the given case, we discussed going concern assumption is appropriate. So is this option possible? No. Unmodified opinion as management has already disclosed the matter. No doubt. That is true. Let's look at C. Unmodified opinion with MUGC para. See, if you look at option number B, can we say this option is wrong? No, it's correct, but it's incomplete. And that's why when you look at the questions with choices, you need to choose the most appropriate. It's not the correct choice, it's the most appropriate one. So that's why we should say B is incomplete. And where do you go? You go to C. Correct? So MUGC para you will include in the audit report. Right? Okay. All right. So now looking at some of these points. Now, what is important as far as the going concern implications are concerned? So one can say that as far as the going concern implications are concerned, some of these details, information, they become critical, and also evaluation of those factors become important. And in fact, in most of the cases, see, because these implications are going to be quite significant, okay, so some or the other information will generally be available with the company. Yeah, it's just that auditor needs to be wary of those facts, circumstances, and the information. And just one point auditor needs to focus on, and that is what? To differentiate between going concern and material uncertainty. Yeah. To say that material uncertainty is there, so that's why going concern is also inappropriate. So that could also be a thought process, huh? But that's what we need to now consider, because that's an important area. Why? Because accordingly the accounting will change, and therefore reporting implications are also quite different in all of these situations, right? So this is it that we had on going concern, right? So now what we can do is, now I think we can take a break. Yeah, we can take a break, and after the break we will continue, and we'll also be looking at some more questions. So Manish, let's take a break. Right. All right, so now moving further. Okay, so I'll just share the document once again, just a minute. We'll now move on to the next auditing standard. Written representations. Okay. Now again, very important document as far as the audit is concerned. And I would say one document over which there's a lot of this lack of clarity. Not because the guidances are not there, but because you can say knowledge awareness is missing at times. And there's also confusion as around it. So that's why I believe that this area is quite important and very important to have a clarity around it as to what does it require. So let's try to first of all understand what a written representation is. What is it that this representation has to do with the auditor? So we can say it's a letter. Who will give this letter? Company. Okay, so it's the management who has to provide. So it's not something which the auditor gives to the management. No, it's the management who has to provide. To whom? Auditor. Now, in this letter, what will be included? So you can say this letter is about the financial statements. The way the financial statements are prepared and presented, the accounting which the company has done, the basis of preparation which they have followed, some of the significant matters, some of the significant judgments which are there, some of the things which remain unadjusted in the financial statements in terms of the misstatements, all of those aspects are required to be included in this letter by the management. Okay, so that's the purpose, that's the requirement in relation to this letter. Now, why should this letter be given? Okay, so let's try to understand as to various requirements in relation to this letter. Say an audit has been performed. Okay, now during the course of the year, audit has been performed. Say it is 24-25. Now, for the purposes of audit, what will the auditor need? A lot of information he'll need. So you can say evidence. Which will comprise of agreements, working details, okay, various supporting information, invoices, purchase orders, correct? Now, despite all this evidence, another important document is required. And what is that? Management representation letter, which is also commonly called as rep letter. Okay, now, during the course of audit, there are a lot of procedures auditor will perform, including the inquiries. And there are a lot of information management will provide. And they will also put down everything in the engagement letter as well as the financial statements. So everything as around the financial statements, they will include in the financial statements, in the notes to accounts, accounting policies which are there. Correct. Now, what is the objective of management representation letter then? See, the objective is that somewhere in a document, management is now giving in writing to the auditor that this is how the financial statements of the company have been prepared by the management. Okay, let's say, for example, say you go ask questions, or if let's suppose, say, questions are asked from you. Many a times it may have happened. Okay. So the person is ready to answer, right? So whenever the questions are asked, the person may answer those questions confidently, or he may be ready to provide the answers confidently. But if let's suppose you ask him that, okay, this is what you told, now please give this in writing to me. Okay, now what are you doing? You are trying to validate. So you'll generally find that the person, before giving that in writing, will think twice. Does it happen or not? Yeah, if you can just relate to this. So that person will think twice before giving that in writing. So verbally, he may be speaking quite a lot, but the moment you say put this in writing, maybe he's short of words. Not because he doesn't know how to write, but because he'll now try to be more careful. Okay, in what he has spoken. That's what the representation letter does. So it's a document which is required to be given in writing by the management to the auditor as regards the financial statements, means as to how those have been prepared and presented. Okay, so that's why it's considered to be a very important evidence. Now, generally there is a confusion that if everything is included in the MRL in relation to every area which is there in the financial statements, be it inventory, be it revenue, be it expenses, be it payroll, be it loans, advances, cash in bank. Okay, then what is the need for a representation letter? Okay, why do you need this at all? Correct. Should you really be needing this? Answer is yes. Why? Because you can say it's a top up to that. It's in addition to what you have already obtained. So just because you have obtained the other evidences, other information, you have performed inquiries, doesn't mean that now you will not be obtaining that. And I've told you the reasons for that. Now let's put it other way around. Let's suppose if the auditor obtains representation letter. So does it mean that auditor can now ignore some of the evidences in relation to some of the areas? There again, it's no. Why? Because this representation letter is not a conclusive evidence. It's no doubt an important evidence, but you can't say that you'll draw conclusions based on this document only. That will be wrong. Okay, because if you were to do this, then what is the purpose of auditing the financial statements? Just think about it. Because then you can just go obtain this letter and your audit is done. Yes or no? Yeah. So audit is not only about obtaining a letter or obtaining a document. Audit is about performance of various procedures. It's about verification. It's about review. It's about analysis, right? It's about challenging the assumptions. There's so many things you do during the course of audit. Okay. So that's why this representation letter, one needs to understand it's required, but because it's obtained, so you can't say that you can now skip some of the other things. Because if you do that, then this representation letter will again be sort of inappropriate. Why? Because you don't know as to what is there, what is the underlying, what is behind this. Okay. Now, many a times what may happen is, say, if there is any critical area, if there is any complex area, if there are some large calculations involved, or maybe some working is involved, which may be time consuming and which may be a bit challenging at times. Okay, over which management is not getting the comfort. It's not that they don't want to provide, maybe it's challenging for them. So, what do you get to hear from the management? That if, let's suppose, you have not obtained the information, okay, so it's a communication from the management to the auditor. If, let's suppose, you have not received the relevant information, relevant data, don't worry, I'll give this to you in writing. I'll give you a specific representation for this. Now the question arises that does that representation, does that specific representation suffice? Answer is no. Answer is no. It's a clear no. Okay, so it doesn't suffice, right? So that's what we need to know as an auditor, and that's how the audit procedures are also required to be looked at. Okay, yeah. So now, in respect of this representation letter, now what are the various requirements that we have? So as we discussed, this letter talks about assumptions the management has taken. This letter talks about accounting policies which the company has followed, the basis of preparation which they have. If, let's suppose, during the year there were some misstatements, okay, which have been corrected post audit. If there is anything pre audit, of course, that will generally be there. But is that really relevant in the context of audit? No. Okay, so if there are misstatements, whether identified by the management itself or the auditor, which have been corrected. Okay, so a summary of that means these were the misstatements which have been corrected. If there are some misstatements which are uncorrected, okay, so many a times there could be some misstatements which are not material, which are uncorrected, and which the auditor has passed. Why? Because those are not material. So that should also form part of this. If there are misstatements which have not been corrected, okay, which have not been corrected and which are material, so what will happen? The moment you say you have material misstatement, so auditor will go in with modification. Yes or no? So even those uncorrected material misstatements should form part of this. Yeah, because that is what the management has acknowledged. Yes or no? That these are uncorrected material misstatements. Right? So this again becomes important on the part of the entity. Okay. Now, next question. When do we require this? So let's suppose we have this reporting year end 31st March, and let's suppose financial statements will be signed off, say, on 25th of May 2025. Let's suppose that's the date when the financial statements will be signed off, 25th of May. Okay. Now the next question arises, that this letter which the management has to provide to the auditor. So when should this be provided? See, generally what you see, this letter is provided near around date of the auditor's report. Okay. Which is also the date the financial statements are signed off. So in fact, if you look at the things practically, see the board meeting date, that's the date. Okay, so you can say that's the date when the financial statements will be approved. That's the date when the financial statements will be signed. And that's the date when the auditor's report is also signed. Okay, and that will also be the date when the rep letter will be provided. Means it has to be of that date. Okay, so practically this is what you find. But this rep letter has to be near around this audit report date only. Okay, so you can't say that there can be a time lag of say 10 days, 15 days, or say the audit report has been given but the rep letter has not been received. Okay, that will be wrong. That will be wrong because you need to have an audit completed with all the required information and then you'll issue the audit report. Okay, in which case, what do you have? In which case, because you are issuing the audit report, so it's sort of assumed that you have all the required information in place. Correct, including the rep letter. Yeah, but practically this is what you find. And now there is another important part as around the rep letter. Now, if we are talking about a rep letter being provided on 25th of May in respect of reporting year 24-25. So this should also incorporate some of the areas like subsequent events, because that should have been considered by the management while preparing the financial statements. That should also incorporate going concern. Yes or no? Because without these considerations, financial statements cannot be finalized, right? So it's not only about the information which is there up to 31st March. It's about anything which is there in the financial statements for the reporting year 24-25. Means relevant to that reporting year is what you are going to look at. Correct? Yeah. So that's what you are going to look at. Okay. Yeah. So let's quickly look at some of the points in your study material. So, what are the thoughts that we have? This written representation is what? This is nothing but an audit evidence. But please note, this is not a conclusive evidence, audit evidence. Okay. This no doubt is an audit evidence, but this is not a conclusive one. Date and periods covered, we discussed. It has to be near around the date of sign off. Okay. What are the important points to be considered? If the written representation are inconsistent with the audit evidence, so what will happen? Auditor will have to go back to the audit procedures. Because entire information, entire evidence has to be sort of moving into a similar direction. It has to be consistent. Otherwise, it will throw some of the indicators for the auditor to revisit or maybe to replan. If the auditor concludes written representation are not reliable, so the auditor will have to look at the reporting implications. Okay. Now, if let's suppose auditor has requested the written representation, but that is not provided by the management. See, practically this will not happen, right? But if let's suppose in a rare scenario, management is not ready to provide. So management is saying that everything as you have asked for, we have provided in terms of the information. Okay. So now you ask for details, invoices. Many times you get to see this, huh? So they may say that if you want to check more invoices, we are happy to provide. But if you've done all the work, then why you are asking for this additional information, which again you are saying is not conclusive because of the reason we just discussed, right? So if the requested representation letter is not provided, what do you do? In such a case, it will put a question mark on the integrity of the management. Yes or no? Because in a way, they are not ready to sign off what they have explained, what they have provided for. Okay, everything which is there in the financial statements is being prepared by the management, over which they have provided all the information. Then what is the problem in giving that in writing? Correct. So this will require an analysis, or you can say a reassessment, and eventually which may also lead to the reporting implications on the part of the auditor. Right? Clear? Any questions so far? Any questions if you have? Now we'll pick up some questions for our discussion. Okay. All right. So now what I'll do is I'll just start picking up some questions. All right. So let's start our discussion with some of these questions. Okay, some of the one we have covered, we'll cover some more. Okay, so let's look at this. Move Fast Limited is engaged in manufacturing of shoes and slippers. Okay, so that's the nature of business of the entity. So they are located in Bahadurgarh in Haryana. Due to unprecedented rains in the area in the month of September 2023, many areas of the town got inundated due to the choking of sewage systems. As a result of the above, companies' premises located in town were also affected, resulting in damage of stocks. So their premises were also affected, resulting in damage of stocks. Okay. So the company has lodged the claim with the insurance company for rupees 1 crore, and the same is shown as claim receivable. So we are looking at the reporting year 23-24. Okay. So there is the claim receivable appearing in the books. Now, insurance surveyor appointed in the case submitted a report to the insurance company recommending a claim of 45 lakhs. So as against this claim of 1 crore, surveyor has approved 45 lakhs. That has been done in April, means subsequent to the year end. Company has also given its consent for the same. Okay. And settled the amount of 45 lakhs was transferred to the bank account of the company. So now it appears this 45 lakh is what company has also accepted. Okay, so there's no dispute. So company is not saying that I'll want more. But when did they receive this? 15th of May. So this was approved on April. You have just finished performing substantive procedures of the company by the end of May 24. Is there any responsibility cast upon you as auditor of the company in the above situation? Over to you. Your thoughts. What
Yes,
is
sir.
it that you'll do as an auditor in the given situation?
Yes, sir. As per the SA 560, it talks about the subsequent events.
Okay.
The events which occurs from that financial reporting date to till the issue of the audit report date of
Hmm.
audit report.
Okay.
Is there any the significant subsequent matters involved that has to be analyzed and report is appropriately?
Hmm.
In, in this given case, it is clearly the management itself they identified as a adjusting event since the event and the conditions is existing at the financial reporting date. They provided the uh, provisions for rupees 1 crore.
Hmm.
But however, on the subsequent period,
Hmm.
the amount was concluded that it
Hmm.
was 45 lakhs only. And
Right.
as per the auditor is concerned, he had to do the procedure to verify whether the amount and accuracy, whether the everything is correct or not. And
Right.
based on that, his conclusion would be he has to ask the management to reverse the existing provisions
Correct.
and accordingly the 45 lakhs only to be recorded at the financial reporting period, that was March 2024.
Right.
If they are able to provide this adjustment, then it is okay. Then the auditor can give the clean report on it. Otherwise, if the management is not ready to adjust and give that 45 lakhs in this matter, then he can provide that qualified opinion as the case may be, or qualify or adverse if that matter is pervasive and material.
Hmm.
This is what my
Sure. Any more thoughts? Any more thoughts? No?
No,
So let's look.
no, no, sir.
Yes, yes, please go ahead.
No, sir. This is what my thought of it.
Sure. Anything that Manish you'd like to add? All right, so let's look at this. See, the given situation provides evidence of the conditions that existed at the date of financial statements. Okay. Clearly, there is a subsequent event. What is that? Approval of the claim, receipt of the claim, against which you have a receivable in the books. Correct? So what do you call it as? As per Ind AS, you will call it as adjusting event. What do you mean by adjusting event? This event will have to be incorporated, means the effect of this event will have to be recognized in the financial statements for the year ended 31st March 24. Okay, so that's what the company will be required. Okay, now in the given case, what should the auditor ensure? So if we look at the chart, so this is 23, 24, right? This receipt of 45 lakhs will have to be incorporated here. So does it mean that we need to now reduce the receivable? No. See, this payment will not be incorporated, but the assessment of the receivable of rupees 1 crore, which the company has recognized, will have to be revisited. When the company is aware that 1 crore will not be received, only 45 lakhs will be received. Why? Because they've done the settlement. Then the receivable to the extent of 45 should only be appearing. Remaining amount needs to be reversed. Okay. Yeah. As an auditor, you need to verify the underlying documents. You need to ensure this event has been recorded adjusting event. Okay. So that's the responsibility. And if not done, then on the basis of materiality, analyze the reporting implications in the given case. Okay. Yeah. So now what I'll do is, Manish, just give me 2-3 minutes. I'll be back. In the meantime, I'll just share the question for the participants to read. Okay. So Manish, I'll just be back in 2 to 3 minutes. Huh? Yeah. In the meantime, please read this. Huh? I'll just come. Yeah. तुलसी बाहर आओ. All right, so let's look at this. CA Anuj is the auditor of a listed company, and he's in the midst of conducting an audit of the said company for the financial year 23-24. Okay. So at a meeting of board of directors held on 17th April, a dividend of 1 crore is proposed to equity shareholders. And such a proposal has a good chance of being approved in AGM. His audit procedures are nearing completion. He is contemplating finalizing the audit report by 31st of July. Now here again, what are the reporting implications? Over to you.
Yes, sir. Shall I?
Yeah, please go ahead.
Yes, sir. So in this case, as per the SA 560,
Right.
the subsequent event, in this
Yes.
case, it is a non-adjusting event. Non-adjusting events is the event
Hmm.
which is conditions and events is arose after the reporting period.
Okay.
Here in this case, that director on
Hmm.
17th April 2024, the dividend
Hmm.
they actually the proposed, but which
Hmm.
is not yet approved.
Hmm.
The approval will happen at the AGM only,
Okay.
which means it is a non-adjusting event.
Hmm.
As far as the audit or auditor responsibility is concerned,
Hmm.
definitely this matter is need not to adjust anything on the reporting date on 31st
Hmm.
March 2024. However, this matter needs to be disclosed as appropriately in the financial statement of 31st March 2024.
Okay.
It is,
Good.
yeah, this is
So
what I
here
feel.
again, we have a subsequent event, but this is non-adjusting in nature. Okay. So when you have non-adjusting in nature, do you recognize that in the reporting year's financial statements? No. That's what we discussed. But depending on the materiality, you need to consider the disclosures for the same. Okay. Now, dividend is something which is important. So that's why a disclosure in this respect will be required. Okay. So therefore, the above situation does not require recognition of proposed dividend. Okay. Yeah. It should be ensured that it is disclosed in the notes to accounts in the financial statements for the reporting year 23-24. And as an auditor, this is what the auditor needs to ensure. Yeah. Because auditor needs to ensure that something which is required to be done, whether that's been done or not. So auditor will have to identify also these things. See, as regards the application of procedure, I would say these events, if are identified, will mostly be addressed. Problem is what? If these events are not identified by the auditor, that's the risk. Because something which has not come to his notice, which should have come, maybe erroneous, okay, as far as their impact on the financial statements are concerned. So that's something which is for the auditor to look at, right? All right, so let's look at the next one. CA Somya, auditor of a company engaged in rearing of poultry butts and obtaining eggs therefrom. Okay. So that's the business they are into. Company has performed very well since its incorporation in 2013. Its sales had also grown, and the company had expanded its market from the native northern state of promoters to far-flung areas in the eastern parts of the country. So it's like company is growing, okay, and they are also expanding across locations. However, since the last 2 years, companies' fortunes have nosedived. First, due to the effects of the pandemic, and then due to the recurrent outbreaks of bird flu, thrice in a span of 2 years. The company's sales have dipped from around 50 crore to 10 crore. So it's a significant fall. Yeah. Further, a major part of its livestock was also wiped off during bird flu. Okay, so you can say effectively that's how the company is able to operate. Yeah, so that's gone. CA Somya is not optimistic about the going concern assumption followed by the management. Okay, so that's the view of the auditor. See, first of all, you need to now understand that whenever such type of situation arises, okay, so that will be requiring the assessment of this going concern. Yeah, the management now wants to start with new batches of birds. The earlier working capital facilities of the company granted by the bank have also been restructured to support the business. So it's an important point. Earlier working facilities have also been restructured. They are already restructured. She was informed that the repayments of restructured working capital loans are to begin from ensuing year. No fresh credit facilities have been granted by the bank. Okay, now this is a concern. Huh? This restructured working capital loans are to begin from ensuing year. Okay, further, there are no fresh credit facilities. Company also plans longer credits from its suppliers of animal feed. So they are looking at the vendors if they can extend the credit term. Company plans to take additional measures to prevent the safety of livestock, including aggressive vaccination, preventive health checkups, and more frequent visits of veterinary staff. The villagers in the surrounding areas have accused the company of spreading air pollution. So this is another problem. The management has prepared a cash flow forecast for an examination. So this is available. Discuss the approach to be adopted by her in examining the going concern assumption, keeping in view above with specific reference to cash flow forecast. Over to you. What do you think you'll do? Yes,
Yes, sir. Sir, here as per the SA 570 going concern,
right.
the auditor actually he has to get sufficient and appropriate audit evidence
Okay.
to determine whether there is a material uncertainty exists,
Hmm.
and the event that may be, is there any to ability to continue the going concern,
Okay.
and accordingly the auditor has to involve in the audit procedure.
Okay.
In this case, it is a clear evident that they are unable to manage a situation, like the fresh loan is not provided, and they are
Hmm.
planning to extend that credit facility from the suppliers,
Hmm.
like that. However, in this case, they are able to do some sort of the plan they have on the hand to
Hmm.
prevent the safety like livestock and include the vaccination and prevent health checkup, all these things. Over in this case, the management has prepared the cash flow also. In this
Okay.
case, in
Hmm.
the as far as the cash flow is concerned, the auditor has to review the cash flow as a way that whether the assumption whatever they involved in
Hmm.
preparing that cash flow, whether it is correct or not. Then the banker, why not they did not give the fresh credit,
Hmm.
and they need to look at that how the fund flows are arranged or managed to solve this problem in the future,
Right.
and what are the assumption behind on this all these things. The auditor has to look into it and provide that cash flow statement is appropriately prepared or not.
Okay.
And also there is a one specifically the villagers also surrounding, they issued that surrounding area accused by the company spreading air pollution. This is also
Hmm.
one of the indicator that the company maybe go for some expenditure out of it.
Right.
If there is any problem or law implication is there initiated, then the
Correct.
penalty may be there. For that, they have to assume some provisions,
Correct.
relegation. They have to look into those matter also accordingly. They have to project. Then they have auditor has to consider whether the going concern is appropriate or inappropriate, or
Correct.
material uncertainty is exist and pervasive nature.
Correct.
And accordingly the auditor has to provide his report as well.
Okay. Great. Good.
Yeah.
All right. So let's look at this. See, when the entity prepares a cash flow forecast over and above this consideration of going concern, analysis of that forecast is a significant factor in considering the future outcome of events or conditions. Because that's how the management is looking at the things which are going to happen in future. Okay. So what should it include? It should include everything which the management is assuming. Because of course the management will take the assumptions because it's future. So will the management be knowing about it? No. So they will only assume that this is how their sales will grow, this is how their new contracts will come. Okay. Now in this case, evaluating the reliability of the underlying data, that's the first part. Determining whether there is adequate support for the assumptions. See, these assumptions are the key. They have to be reasonable. Means something which the management can justify. They should look logical. And if, let's suppose, management is taking the assumptions, there has to be some basis for that. They can't just say that this is our thought. If they are thinking, then there must be some backup for that. Yes or no? Yeah. So I would say these assumptions are very critical for the auditor to look at, right? So the auditor should verify assumptions regarding fresh batch of livestock. Bankers have not provided fresh cash facilities. How the funds from the same would be arranged. Reasonability of assumptions, something that we have been talking about. Further, she needs to check loan sanction letters, agreements to verify when the repayments are beginning to see their accuracy in the cash flow forecast. What is the cash flow projections? Cash inflows, cash outflows. Company plans to avail longer credits from the vendors. Okay. So in the downturn situation, how would the suppliers extend longer time? See, in fact, in such a situation, supplier would want to cut down on the credit term. Okay. So it's something which is completely opposite to what should have been, which the company is planning, which is going to be very difficult. Huh? So this is going to have effect on the cash flow forecast. Whether the company has accounted for increased expenditure on preventive health checkup, vaccination, and more frequent visits of the veterinarians. Means these additional cash flows or cash outflows, I should say, whether those have been incorporated or the management is just trying to present a rosy picture by hiding some of these future cash outflows. Since the villagers have accused the company in respect of this air pollution, how does the company plan to deal with the same? Will that also require any cash outflow? Okay, now if that is the case, whether that has been incorporated, now cash outflow could be in respect of maybe the corrective actions, maybe the penalties which may be imposed. Yeah, so some of these factors will be important to be looked at in the given scenario. Okay, next, let's look at this. CA Suraj, so auditor of the company, finds that key financial ratios of the company, for example, current ratio, debt service coverage ratio, inventory turnover ratio, trade receivables turnover ratio, okay, they are in red. Red means unfavorable, adverse action, and they have deteriorated considerably as compared to the previous year. Company is also not able to pay to its creditors on time. Okay. Company is requesting time and again to its bankers to grant additional credit facilities, but the bankers are not listening. So it's a problem. Huh? So the company is requesting, but there's no approval. Okay, so it's not like the application is under process. No, so means there's no approval for that. There have been significant losses to the company due to lack of response of company's products in the market. As a result, many products are sold at below cost price. There have been situations where the company is not able to pay the salaries of the staff on time. Okay, so cash flow crunch, you can find out. All these negative findings have led him to conclude that use of going concern as a basis of accounting is not appropriate. Okay, so auditor has drawn the conclusion. What is the conclusion? Going concern is not appropriate. He brings this matter to the knowledge of CFO of the company. Now, what is the reporting duty cast upon him in such a scenario? I think this is question number 1. Okay. CFO informs him that the management in turn is ready to include in the disclosures the inappropriateness of its use of going concern assumption of accounting. How should it impact auditor's opinion in case the management itself discloses the inappropriateness of its use of going concern assumption of accounting now? Okay, so situation number 2, right? So I think this is it. So any thoughts on this?
Yes, sir.
Yes,
Yeah, going concern. Maybe
right,
say 570. Yeah, it's talk about. It is a fundamental assumption. The concern will continue its operation for the foreseeable future and at least for 12 months from the reporting period.
correct.
But in this case, the auditor identified lost a lot of inconsistency with respect to that.
Okay,
Yeah, it's clearly identified many things,
right,
and it has rightly discussed with the CFO as well. The
right,
CFO also is agreed in this case.
right, right.
And the first part of it, when the auditor is based on his judgment, professional judgment, and the
Yes.
matter, the going concern is feel is not appropriate when the
Okay,
material uncertainties exist. Here and the
right.
uncertainties exist. Definitely,
Okay,
he will provide the adverse opinion about it.
okay,
On the question number one,
right.
with respect to question number two,
Yes,
again they are ready to disclose the CFO in the financial statement with respect to the inappropriateness, and they are part according to it. They are ready to disclose it.
right.
Whether they are disclosing or not disclosing, that is immaterial. But
Hmm.
inappropriate is inappropriate only. The
Correct,
auditor conclusion will no difference. Again, the auditor will give the adverse opinion. But
right,
yeah, if it is appropriate and material uncertainty is there, that is a different story. But in the
correct,
inappropriate once it appear, then definitely on auditor, whether the management given that disclosure or not, it is a duty of the auditor to give the adverse opinion straight away on the second case as well.
correct, right. Very good. So now let's look at this. See, if the financial statements have been prepared using going concern basis of accounting, but this going concern basis of accounting is inappropriate, so what should the management do? Adjust the financial statements, bring them to liquidated values. If they don't do this, then it's a impact, material impact and pervasive. So that's why there is no option but to give adverse opinion. Okay, so that is your question number one. Now, this requirement for the auditor to express an opinion of adverse opinion applies regardless of whether or not the financial statements include disclosure of inappropriateness of management's use of going concern basis of accounting. Correct? Because if the going concern basis of accounting is inappropriate, then disclosure will not work. Disclosure, no doubt, is required. Adjustment of the balance sheet items will be required. So if the management will do that, adverse opinion shall go away because now it's corrected. But if that's not done, that means there are uncorrected material misstatements flowing throughout the financial statements. Yeah, right. So in the second situation, therefore, what will happen? The same adverse opinion shall continue. Right? Let's look at the next one. So I think we are given a lot of data here. Okay. Ramadhan and Company are the auditors of XYZ Company Limited for the year ended 31st March 24. Audit report for that year was signed by Ramadhan and Company on 4th May 24. AGM was decided to be held during the month of August 24. On 6th May 24. Okay. Means after the audit report is signed off. Now these dates are important. report signed on 4th May. Then AGM is when? AGM is in August 24. 6th May means after the audit report is signed off. Company received a communication from the central government that an amount of 5,800 crore kept pending on account of incentives pertaining to the financial year 23-24 had been approved, and the amount would be paid to the company before the end of May 24. To a query to the CFO of the company by the board, it was informed that this amount had not been recognized in the audited financial statements. In view of the same not being released before the close of the financial year and due to uncertainty of receipt, which is a fair point. Yeah. Now, having received the amount or having maybe received the confirmation, okay, board of directors wished to include this amount in the financial statements for the reporting itself. So that's why what did they do? On 8th May, board amended the accounts, approved the same, and requested the auditor to consider this event, issue a fresh audit report. Right? So analyze the issues which are involved and give your views as to whether or not auditors could accede to the request of the board of directors. Yes, over to you. What are your thoughts? What should be done?
Yes, sir. This is actually the subsequent event.
Okay.
Yeah, as per SCA 560.
Yes.
Yeah, here it is a clear case that the government has that 5,800 crore kept pending
Right.
incentive
Right.
and approved. But it's a definitely it's a non-adjusting event because
Okay.
that the event has a condition and event arose after the balance date.
Right.
Definitely, this is the fact which came to know that the auditor after the date of auditor report.
Right.
But it's a clearly it is a before financial statement are issued.
Okay.
But since the auditor is issued the report already,
Right.
and definitely the auditor can go and approach the management.
Right.
They ask them to management of those charged with governance to discuss about this matter,
Right.
and they need to determine whether the financial statement whether it is a amendment needed or so,
Okay.
and accordingly the management has to take a address on this matter in the financial statement. If they are ready
Right.
to amend anything in the financial statement, definitely the auditor will go the audit procedure for the amended items
Right.
and look into that. But
Okay.
in this situation, it's very clear that after financial report is signed off,
Right.
uh, definitely they can amend that audit report. One more
Okay.
that report, but not the report auditor report date should be very clear.
Right.
After approval of the auditor financial statement only, the auditor report should be signed off. I mean
Okay.
the amended financial statement.
Right.
Accordingly, they can conclude this matter, sir.
Okay. Good. Now, let's look at this. Clearly, we have some subsequent event here. Okay. So now, as regards these subsequent event, which have come after the audit report is signed off, but before the financial statements are issued. Okay. So it's that situation. But before the date of financial statements are issued. Okay, so in this case, what should the auditor do? Discuss the matter with the management, no doubt, TCWG, no doubt. So the discussion is a first step. that anyways has to happen. Determine whether the financial statements need amendment, which has been done in the given case. Inquire how the management needs to address the matter, that has also been done. Okay. Now, in this case, this auditor can issue a new audit report subject to date of audit report, which should not be earlier than the date of approval of amended financial statements. On the top of it will be the audit procedures in respect of this adjustment. Yeah. So when this adjustment is there, so the underlying documents for the basis of this adjustment in the financial statements will have to be understood. Clear?
Yes, sir. Whenever there is a adjustment, definitely the auditor has to do the procedure whether they appropriately they disclosed or adjusted or not. That is the
Yes,
procedure. Then only
correct.
he can issue the report accordingly.
Exactly. Exactly. So that's a must. That's a mandate. Huh? So just because amendment is required doesn't mean you'll go and amend. Okay. So whether amendment is required or not required, what is that? You are giving the report. So before the report, you will perform the procedures. Correct?
Yes, sir.
So let's look at the next one. Messrs Airlift Limited, which is carrying on the business of passenger transportation by air, is running into continuous financial losses as well as reduction in sales due to stiff competition. So one, you have continuous financial losses. Sales are also going down. Frequent breakdown of its aircrafts. Now, financial statements for the reporting year 23-24 are to be now finalized. Management is quite uncertain. It's not quite certain, quite uncertain as to its ability to continue in the near future, and has informed the auditors that having seized of this matter, it had constituted a committee to study this aspect and to give suggestions for recovery, if any, from this bad situation. Till the time the study is completed, according to the management, the issue involves uncertainty as to its ability to continue its business, and it informs the auditors that the fact of uncertainty clamping on the going concern would suitably be disclosed in the notes to accounts. Now, in respect of this matter, what do you think will be the reporting implications? So I think it's quite straightforward. So let's look at this. Reporting requirements in case of uncertainty as around the going concern. Okay, if that is there, so what are the auditor's considerations? Adequately disclose the principal events or conditions, and management's plan to deal with those events or conditions. That's one. Two, disclose clearly there is material uncertainty related to events or conditions. Okay. Therefore, it may be unable to realize its assets and discharge its liabilities. If the adequate disclosure is given, then the modification in the opinion is not required. But yes, section para is included in the report around what? Material uncertainty, which is also called as MUGC. By including this para, in a way, auditor is highlighting somewhere in the audit report around the disclosure. Okay. So idea is what? To draw attention to the note in the financial statements. State that these events conditions indicate a material uncertainty that may cause significant doubt on entity's ability to continue as going concern. Okay. As well as the fact that the auditor's opinion is not modified in respect of this matter. Okay. Now, in the given situation, what has happened? All of these problems have been found out. So what should the auditor do? Considering the disclosure, okay, which the management plans to include, auditor shall disclose about material uncertainty, express unmodified opinion, which means auditor will move with this MUGC para. Okay, clear? Next. PRSH and Company is the statutory auditor of Make My Journey Limited. So company is in the business of tours and travels. Annual turnover is 2000 crores. Profits are 190 crores. During the planning meeting of the management and the auditors, it was discussed that the management needs to provide written representation letter to the auditors for the preparation of the financial statements, completeness of the information provided. At the time of closure of the audit, there has been some confusion about the requirements of this written representation letter. Management argued that the representation need not be written. It can also be verbal, which has already been provided, because verbally everything has been provided. Auditors have completed their documentation, and hence, in a way, representation based on verbal discussions with the auditors has also got documented. Auditors explained that this is mandatory to be obtained. However, still some confusion remains regarding the date and period covered by the written representation. You are required to advise about the date of period covered by written representation. Okay, over to you. Yes. Any thoughts?
Yes, sir. See,
Yes.
here again, SA 580, it's talk about written representation.
Right.
The auditor should also get the sufficient and appropriate audit evidence relating to that written representation as well, because
Right.
the audit and the management is the whole responsibility for preparation and presentation and disclose of the financial information.
Right.
Whether they are is their responsibility, whether they have prepared, included or recorded each and every matters
Hmm.
in the financial statement, recorded or not. That is a
Correct.
primary responsibility of management. They have to provide the information
Right.
to the by way of written representation.
Correct.
As far as the auditor is concerned, he has to do the sufficient and appropriate audit evidence, as well as he has to get the written representation. The
Right.
both will constitute as a audit evidence in the
Correct.
matter of audit.
Yes.
In this given situation,
Hmm.
sometimes there not be the written communication, verbally is discussed, all those things they given.
Right.
Again, the management has to provide the written representation only, not via that oral word or something. It's not
Correct.
appropriate. They have
Yes.
to reconsider that.
Correct.
That is very much important and needed on this.
Okay. Good.
And with respect to date, we should not be later than the audit report. It has to be prior to the audit report. The MRL should be.
Right. So that is
Yeah.
again a very important consideration on the part of the auditor.
Yes, sir.
Okay. So now,
Like subsequent event.
yes, of course. Okay. And anyways, all of these areas are quite important. Yeah. So let's look at this now. Written representations are necessary audit evidence. Can it be avoided? No. Okay. Now, because the auditor is concerned with events up to the date of auditor's report, Okay, to incorporate their impact. Okay, as we have been discussing about subsequent events, what do you do? Written representations are dated as near as practicable to, but not after date of auditor's report. In some circumstances, it may be appropriate for the auditor to obtain written representation about a specific assertion, wherein it may be necessary to request an updated written representation. Written representations are for all periods referred to in the auditor's report because management needs to reaffirm that the written representations it previously made with respect to the prior periods remain appropriate. Auditor and the management may agree to form a written representation that updates the written representations relating to prior periods by addressing that there are any changes to such representations. And situations may arise where current management were not present during all the periods referred to in the auditor's report. So such persons may assert that they are not in a position to provide some or all of the written representations because they were not in place during the period. This fact, however, does not diminish such persons' responsibility for the financial statements as a whole. Accordingly, what do you do? Requirement for the auditor to request from them a written representation that cover whole of the period still applies. Okay, so that will continue to remain. So let's look at the next one. CA Shobit is conducting audit of XYZ, and we have this reporting year 23-24. Company is engaged in export of handicraft items in Europe. Audit is nearing completion, which is the month of July. However, it becomes known to CA Shobit that one of the overseas buyers has made a legal claim against the company on 1st June for injury caused to a customer of one European buyer due to substandard dyes used in rugs of one lot of orders shipped in August 23. The management of the company has decided to agree to an out of court settlement of 4 crore to protect its reputation. The financial statements are silent on the issue. Discuss how should the auditor deal with this matter. Yes, any thoughts? So what should the auditor do?
Yes, sir. It's clearly it's talk about the subsequent event,
Right.
that event and consistent as at the financial reporting date.
Okay.
Definitely, the management have decided to agree on the outcome of settlement. In this case,
Right.
the company is very silent about it.
Right.
See, as per the subsequent event, the SCs 5 6 talk about if there is any event and condition and if it is adjustable event, then
Right.
it has to be recorded in the
Hmm.
financial statement.
Hmm.
But in this case, since the management is silent, definitely the CA definitely give the report on it, issue
Sure.
the, yeah, modified report.
Sure. Good. Now, in the given case, what has happened? Okay, so it's a legal claim against the company. So there are some financial implications amounting to what? 4 crore. Clearly, it's an example of subsequent event. Yes or no? Now, for a subsequent event, what do? You'll have to check whether it is adjusting or non-adjusting event. Correct? If that is adjusting event, what do? You will record that in the reporting year itself. If not, then again, considering the materiality, you'll at least give a disclosure. Okay, so that's something you'll do. Okay, now in the given case, what should the CA do? So the CA has to ensure appropriate adjustments and disclosures. Now, if that is not done, then definitely it's a non-compliance of accounting standard. financial statements to that extent will remain misstated. Correct? So if there is any misstatement in the financial statement, so what should happen? There has to be some reporting implications for that. Now, what do you mean by reporting implications? Now, again, depending on the materiality, that auditor will have to analyze, okay, as to whether to go with modification or not, because it's clear either it will be a modification or not, depending on whether the adjustment is passed in the books of accounts or not. Correct? Yeah. So, all right, with this, we are through. Thanks once again, everyone, for your time today. Thanks so much.
Thank you so much, sir.
Thanks. Manish, we can close this now. Right. Thanks.